So at this point, I am, and we as a class are flipping over from the individual, which we've been talking about, or some basic economic type concepts, to firms, okay? And specifically, I really don't care, and we don't care, whether it's a corporation or a sole proprietorship or a partnership. What we're more interested in is the industry structure. And so what we're going to start with today in this chapter is costs. And then next week, we'll start looking at each of the individual markets, okay? Not sole proprietorship, but pure competition, monopoly, things like that. One quick note, and I already set it up for next week, just kind of your textbook splits pure competition up into 2 chapters. I'm going to cover it all as one. So for next week, it's going to look like there's 2 chapters of Learn Smart that's due. Keep that in mind, because your textbook has it as 2 chapters. It really probably should be 1. So with that being said, we're going to start with the costs of production. And there's some things that a company, okay, needs to answer. One is how much to supply. How many am I going to make? Okay. Am I going to make 100 units or 1,000 units, what have you? Okay. And that's going to be a question that we're really interested in here today, what have you. How to produce that output, we're really less interested in. Okay. We are going to assume, and you could argue with me all you want on this one, that GM knows how to make cars. And so they're going to produce it in the most efficient way possible for them. Okay, so we're not going to so much as question how they do it. We're just going to accept that they have made those decisions, and they're the ones that know how to do it, so they're going to do that. But we are going to look at how costs vary with output. Okay, and do they vary with output? You often hear today, oh, the big companies have a huge advantage. And my argument would be maybe. Okay, and which gets to my next question there, do large firms have a cost advantage? And the best response there is maybe. So often we think they do, but then you start to think about it, okay? There are 2 cola companies, Pepsi and Coke, basically, but there are thousands of wineries. There's probably 20 to 50 of them just in Southwest Virginia. Okay, so do they have a cost advantage? Well, why aren't there just a couple of big wineries when there's a couple of big cola companies? Okay, and we can go through a whole bunch of industries like that. You know, some industries, yeah, there's 2 or 3 big guys. Okay, cell phone providers, carriers. Okay, there's really kind of 3. You know, AT&T, T-Mobile, and no, I'm going to say Verizon. Okay, so why are there only 3 of those, but why are there hundreds of wineries? Why are there, you know, and so we're going to take a look at that. And the other item, and this often confuses, if you will, students, just because we produce at the lowest cost doesn't mean that we make the most money. Okay, and this often kind of shocked me, if you will, when I was younger, because you would think that the lowest cost producer would make the most money, and yet you find frequently they don't. And so we're going to take a look at that. And in fact, often the companies could produce something for lower cost, but they don't. Okay, and the question is why not? And frequently the answer to that is because that doesn't make them the most amount of money. And then the last question, which is going to get into, you know, what we're going to talk about, let's say in 3 or 4 weeks yet, is how much of each input should we demand? And when we're talking inputs, we're going to go back to kind of chapter 1. And remember, there was land, labor, capital, and enterprise. Okay, and what for our purposes, we're just going to talk about labor and capital. Okay, we're going to take a look at those 2, labor and capital, assume they're interchangeable, what have you, realizing that land, entrepreneurship, what have you, are there. but we're not going to necessarily worry about those particular inputs as much. So now what do we need as far as information goes? We need to know the price of the output. So we need to know how much you can sell it for. Okay, what's the selling price? We need to know that. We need to know the price of inputs. And here, especially in a couple of chapters, we're going to talk what's the price of capital and what's the cost of labor. Okay, now land, as I mentioned, land is there, enterprise is there, but the two that we're going to worry about are capital and labor. What's the production technology? And for the most part, we're going to assume that that's a given. Okay, just like we did back in, I guess it was chapter 1 when we talked about the production possibilities curve. Hey, current production techniques are given. Could they change next week, next month, next year? And the answer is heck yes. Okay, I think you're going to find that the virus, COVID, whatever, is probably going to change some production techniques. Okay, it's probably going to change the way we do some things. I think the first thing you're going to see is things change at restaurants. Okay, in fact, obviously I've been on vacation for a couple of weeks. More and more restaurants aren't even passing out a menu anymore. Okay, they're having you download, okay, with one of those codes, the menu on your phone. Why? So they don't have to touch it. They don't have to worry about germs. They don't have to worry about some of those things. Okay, there have been restaurants for years that have allowed you to pay at your table. Okay, so when you're done with your meal, you don't have to wait for the waiter or the waitress to come over and hand you your bill and then hand him or her your credit card and wait for them to come back, whatever. You could just pay with your Apple iPhone, okay, or your Samsung Pay, what have you, right at your table. Okay, so I think there's going to be some changes there as far as we see things from a production technology going forward. But we'll continue to see what happens. I know, and I haven't walked into many, but the McDonald's I've walked in have almost totally gotten away with the individual that's going to take your order and steers you right to the kiosk and says, order it yourself on there or do it on your cell phone and pick it up outside. Okay, so production technology is a given, but it changes over time. Now we have to make a distinction between economic profits and accounting profits. And this is where some of my accounting folks in the class after this are going to not particularly like me. Because from an economic perspective, we say those accountants missed some costs, okay? Explicit costs are those accounting costs. And for those people that take accounting or have taken accounting, all of those things we talk about in there, the land, the rent, you know, cost of materials and labor and whatever, those are explicit costs. But from an economic perspective, what we say is those accountants have missed two costs. One, they've missed what we call a normal rate of return on capital, okay? And they also missed opportunity costs. Those costs, hey, what else could have you done with that investment, that money? And I will tell you this, if you ever are in the business or looking to buy a small business, whatever, they'll go through all the costs, okay? And they'll say, oh, look at the profit. And they'll show you that profit figure, whatever. All that includes are those explicit costs. And they'll say, look, and I'm going to use, you know, an example, perhaps in Allegheny County, you're going to make a profit of 40 grand a year, 50 grand a year, whatever that number is. And that all sounds pretty good until you realize you're buying a business and that 40 grand includes the costs of buying that business. Okay, you spent 100 grand. Okay, if you didn't spend the 100 grand to buy the pizza pit, you could have spent that 100 grand on something else and had some investment return on that. And it also does not include your time. 40 grand sounds good until you've realized you've just given up a job at the mill that pays 80, 90, or 100. Then all of a sudden working, 80-hour work weeks and being on call 24/7 and being there when somebody doesn't show up or whatever doesn't look so good. And so when they're trying to sell that business, they show you that 40 grand profit and they go, isn't that a great number? And then you start including these other costs that the economist wants to throw in, and 40, 50, 60 grand doesn't look so enticing anymore. And what we're always looking for, okay, is, I'm going to argue break even. And break even means they take their revenue, they subtract their explicit costs, i.e. their accounting costs, and the implicit costs, those two costs we just talked about. And if you include all those, you should have a profit of zero. And that is a normal profit. That's what we call, your textbook calls, a normal profit. You should expect to earn a rate of return on your investment. If I bought 100 grand, if I paid 100 grand for the pizza pit, maybe I should expect, and I'm going to make up a number here, 7%. Okay, a 7% rate of return is a fair return for putting my money, my investment into the pizza pit. So at that 100 grand investment, I should make 7 grand just off the top. Those are where my implicit costs come in. And what normal profit means is that economic profits are zero. Okay, so a normal profit means that economic profits are zero. So when companies are showing an accounting profits I don't care about, because accounting profits only include these explicit costs. I want to know what's going on with those implicit costs, because that's going to tell me whether an industry expands. Okay, if economic profits are great, if they're earning more than a normal profit, 50 grand, it's going to attract entrants. People are going to want to come into and compete against me. Why? Because I'm making a ton of money. If, on the other hand, I have economic losses, it encourages market participants to leave the industry. Okay, what that's going to do is encourage people to go elsewhere. Hey, you're not earning a fair rate of return on your investment and your time. That pizza pit may be earning you 40 grand. But when we subtract the 6 grand that you should make from that $100,000 investment, now we're down to 34 grand. When we take into account the opportunity cost of not working at the mill for 80 grand, and I'm just making up a number here, all of a sudden we have a $46,000 hole. So what am I going to try to do? I'm going to find some other, pardon my language, sucker to buy the pizza pit from me, buy it for 100 grand. And yeah, he or she's going to make 40 grand a year in accounting profits, but I'm going to invest that 100 grand in something else. I'm going to get a job down at the mill that pays 80 grand, and I'm going to be well ahead of where I am running the pizza pit. That's the idea between economic profits and economic losses. Questions? And that's when revenue minus explicit minus implicit cost is less than zero, i.e. a negative 46 grand. Now we're going to talk about the short run and the long run, and you're going to find this, I mean, even in the next chapters, we're going to talk about what happens in the short run versus what happens in the long run. A short run is a period of time so short. Notice I don't talk about it in terms of days or weeks or months. It depends upon the industry, okay? Where a firm cannot change their scale of operation and additional firms can't enter or leave the industry. What we assume is capital is fixed and labor is variable. And my example here is usually campus. Okay, assume that we're open, we have classes going on, what have you. In the short run, if we have an empty classroom, theoretically, we can hire an instructor and increase the number of classes offered. Okay, but keep in mind, the amount of buildings is fixed, but labor is variable. In that case, I can add another faculty member or an adjunct or what have you. Okay. And if you want to think about it, a short run is a period so short that the firm can't change their scale of operation. Right now, we're in the middle of a semester. Is there anything we, theoretically, could we add a short class for a couple of weeks here to, yes. But in the grand scheme of things, we'd have to hire somebody, what have you. It'd be very difficult. So we couldn't change our scale. Right now, the classes we've offered, we're kind of stuck with through the end of the semester. Now, come summer, could we add some? Sure. Come fall, sure. But then the long run is a period of time long enough that the firm has no fixed factors of production. Firms can enter and leave the industry and adjust their size. In the long run, I can even increase the number of classrooms. Okay. In the short run, I'm stuck with the amount of classrooms I have, perhaps the faculty I have, what have you. In the intermediate term, could I add some faculty, what have you? Yes. In the long run, could I build as many buildings theoretically as I wanted to and fill them up with faculty and students? And the answer is yes. Okay. So in the long run, you have no fixed factors of production. Firms can enter and leave the industry. They can come in and they can go. Okay. And they can adjust their size. They can usually hire more capital. Labor, we assume, is relatively speaking available. And as I mentioned, that varies tremendously between industries. I could express this as a mathematical expression, okay? I'm not going to do that in too great of detail just because I would see your eyes glaze over if we were in the classroom. Already talked about our inputs. And we're going to talk in terms of productivity, which is output per unit of input. And we usually talk in terms of output per man hour, okay? And so usually what we're doing is talking in terms of output per man hour. If one person works an hour, how much output do we get? Okay. That's how we usually measure productivity. And the productivity of any factor of production depends upon the resources available to that factor. Okay. I had a student, and this was probably 25 years ago now, from Southeast Asia. And she was absolutely amazed, and we're going to see this again in a couple of chapters, at how we build roads. She goes, gosh, they used a ton of labor, okay, and very little machinery. And I go, of course, in your country, labor is cheap, so you use a lot of it. Here, labor is expensive, so when you look at them building roads or what have you, or laying asphalt and what have you, boy, we have a couple of people and a whole lot of expensive machinery, okay? And how productive you are is determined based upon the resources that you have. Now we're going to talk in terms of three terms here. First is total product, which is the total output produced. We're going to talk about the average product, which is the total products divided by the units of labor. Perhaps it's man hour, perhaps it's man hours or whatever. And then we're going to talk about marginal product, and that is the change in total product divided by the change in inputs. Okay, how much more do we get if we add one more worker? And for the most part, we're generally going to use labor. Could we use any of our resources? And the answer is yes. For our purposes, we're gonna pretty much just use labor. And so look at what we have here. And the way I like to think about this is I like to think about this as a local McDonald's shop. Okay. And I want you to think about what happens at that local McDonald's shop. Okay. And I know it says gene production in pairs per day. This applies to any business, just the numbers are different. If I'm working at McDonald's, whatever, and I have no workers, I get no output. Okay. If I have one worker, keep in mind now that worker is, I'm talking about a McDonald's here, they're taking your order, they're accepting payment, they're handing you your change, and they're making their burger or your burger and fries and whatever else you're having. So as we hire that one worker, do we get some output? Yes. Okay. What is our marginal output? Well, our marginal output is the change. We went from 0 to 15. So our marginal output of that worker is 15 units. And our average product is 15 divided by 1, or 15. Now what we do is we add a second worker. Okay. And when we add the second worker, now all of a sudden what we're probably going to do, once again, McDonald's, we're going to have one person work the cash register, get the orders ready, whatever, and the other person cook. Okay. And notice as we do that, total output goes up to 34. The marginal output goes up to 19. How did I get that? 34 minus 15. And my average product goes up to 17, which is 34 divided by 2. Where did I get the 2? Up there. Now, if you think about in terms of McDonald's, they usually have, 4 or 5 people working. But at some point, why don't they have 50 people working at the counter at McDonald's? Because if we put 50 people behind that with a fixed amount of capital, they'd be stepping on each other. They couldn't move. They would not be very productive. That will always occur. When you add more labor to a fixed amount of capital at some point, okay, marginal product will begin to fall. So notice what happens when I hire the third worker. Do I get more output? And the answer is yes. But notice what starts to happen to my marginal output. 44 minus 34 is 10. My marginal output starts to go, my marginal product, pardon me, starts to go down. And then my average product starts to go down. And as I hire more and more and more workers, my total product goes up, it reaches a maximum, and then it starts to go down. Hold on 1 second, please. Sorry about that. Had to turn my phone off. So notice what happens now to my marginal product. My total product goes up, hits a maximum, and then starts to come down. My marginal product starts falling a lot sooner, continues to decrease. Eventually it reaches 0, and then at some point it goes negative. Okay, at some point it goes negative. And so what's going on when it goes negative is that as I add more workers, I am in essence getting less output. Consider that local McDonald's. Okay, as I continue to add more and more workers, at some point, they start to run into each other and productivity starts to go down and the marginal product begins to fall. And notice my average product goes down as well. So that's what's going on. And I don't care what type of business you have, they all have these characteristics. They come in at different spots, but they all have these characteristics. So now if we're going to graph it, our total product is going to look like that. It's going to reach a maximum and then start to fall. Our marginal product is going to go up really quick, reach a maximum, and then begin to fall. And at some point, go negative. And finally, our average product. Okay. Now, our average product is going to cross our marginal product, or our marginal product is going to cross our average product right there at the peak of the average product. Okay, right there at the peak is where it's going to be. And keep in mind, y'all know this. Okay, now my graph over here on the far left is not very correct. If you're not happy with your grade in class, the way to improve your average is to score better on the next homework, the next assignment, or the next exam. Why? Because your marginal score, the score on your next exam or your next assignment, will push up, drag up your average. And the only way to get your average to go down in a class is to have your next exam, your next assignment, whatever, be lower than your average. What will that do? That'll drag down your average. So the only way to get the average to come down is to have the marginal below it. Okay. So we know that the marginal is going to cut the average at its peak. Okay. And you all know this from grades and what have you. So these are kind of the notes that just go with that graph that I just had. All three curves are going to rise for some period, reach a maximum, and then begin to fall. The marginal product will cut the average product at its maximum. And remember what we're doing here. We're adding a variable input labor to a fixed input of capital. The reason why this occurs is what we call the law of diminishing returns. At some point, as more of a variable input is employed with other resources held constant, marginal product will fall. As we add more and more labor to a fixed amount of capital, at some point, marginal product will fall, pardon me. Can't tell you exactly where, but at some point it will. And keep in mind, if you've ever worked at a restaurant, and restaurants I'm using because that's where I've worked and had the most, experience. If you think about it, the managers, do they have a formula? I'm sure they may, but more often it's not. And when they start letting people go as the day goes on, especially after the evening rush, what are they trying to do? They're trying to maximize their income by reducing their labor. Okay. Questions on our marginal product, average product, and total product? Those three concepts become important as we talk about costs. So now so far I haven't talked about costs. Now I'm going to switch over to costs. We can have short-run costs, and fixed costs are costs that do not vary with output. Things such as rent. You're paying $400 a month. I don't care how many people come into your store or how many items you produce, you're paying $400 a month. Okay. Depreciation is frequently a fixed cost. Insurance could be a fixed cost. It could also be variable depending upon the type of insurance it is, what have you. And variable costs are costs that change with output. Things such as power or materials. And, if you think about it, I'm going to use a car, you build one car, you need 4 tires. If you're going to build 2 cars, you need 8 tires. If you're going to build 3 cars, you need 12 tires. And so what's going to happen is those costs change as output changes. Okay. And that's just a real blatant, if you will, example. And note that you can change one cost into another. And I don't talk about it in here, and I'll be talking about it in management accounting over the next couple of weeks. But you can change one cost into another. And you go, well, how do you do that? Well, if I pay my employees per hour, it's a variable cost. They work 1 hour, I owe them $10. They work 2 hours, I owe them $20. They work 3 hours, I owe them $30. Variable cost. I put them on a salary, $8,000 a month, $5,000 a month, whatever the number is. All of a sudden now it's a fixed cost. So are there costs you can move from one to another? And the answer is yes. Now, the total cost is the sum of the fixed and the variable costs at each level of output. Now, some quick notes. How fast total costs rise is only dependent upon variable costs. Since fixed costs are by definition fixed, they do not impact how fast total costs rise. Okay, only variable costs do. There is no upper limit. Okay, so there's no maximum. And the minimum total cost is our fixed cost. If I decide to close my shop, just ask a lot of people what happened during COVID. Okay, now slightly different in COVID just because of some rules the government passed. But they could send everybody home, turn off the lights, lock the door. They still have to pay rent. So rent is a good example of a fixed cost. Okay, and the minimum of total cost is your fixed cost. Now, quick note here, and I'm not going to there are a number of tables in your textbook that go through all this, and you can kind of follow along. I don't think I'm going to be pulling up some of those chapters and doing that, but your textbook does provide a lot of examples there. Now, in the long run, there are no fixed costs. In the long run, that restaurant gets out of their lease, turns the keys back over to the landlord and says, I'm done. Okay. And you're hearing businesses doing that now, you know, at COVID, you've heard of some businesses, especially restaurants that have closed, perhaps permanently, what have you. So in the long run, there are no fixed costs. So the big difference between the short run and the long run is in the short run, there's fixed costs. In the long run, there are not fixed costs. Now we can break up each of these costs into a couple of different pieces. We can take total fixed costs and we can break it down into average fixed cost. And average fixed cost is our total fixed cost divided by Q. Okay, where Q is our output. How many did we produce? Average fixed costs will always fall. They never reach zero, but they get closer and closer to zero. And one final note, you can never graph total costs with marginal or average because the scales are so different. So let's go ahead and graph fixed costs. On the left-hand graph, I'm going to graph total fixed costs. And in this case, they are perfectly horizontal at whatever they are. In this case, I've got 75 grand. But notice what happens to my average fixed cost. And notice, at 1 unit of output, I have 75,000 divided by 1. So my average fixed cost is 75 grand. At 2 units, it's 37.5, if my math is correct, because it's 75 grand divided by 2. So it's 37,500. So notice what happens. My fixed costs plummet. And then as time goes on, they get slower and slower. And way out here at 75,000 units of output, it's $1. Okay. And at 150,000 units, it's 50 cents. So it keeps getting closer and closer and closer to zero. Will it ever get to zero? And the answer is no. But it's going to get closer and closer. So average fixed costs plummet. And then they kind of, I'm going to say, level out. Okay. And they start to fall a lot more gradually. So that's what my fixed costs look like. Now I can talk in terms of variable costs. And I can talk in terms of total variable cost and average variable cost. And average variable cost is total variable cost divided by quantity. Now, what happens to average variable cost is it goes down for a while, some period. It'll reach a minimum and then increase again. So it's going to be U-shaped. It's going to go down, 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 reach a minimum, and then start to head back up. It's going to be what we call U-shaped. The reason this occurs is the law of diminishing returns and our relationship with the production function. So my total variable cost is usually going to look something like this. Okay, it's going to be start off at 0. It's going to go up pretty fast and it's going to level off. It's not going to get totally level, but it's going to get less steep, if you will. And then at some point, it's going to continue to go and rise very fast. So it tends to look something like that. Okay. And my average variable cost is going to look something like that. And I think my graph on perhaps the next slide will kind of help explain why. But it's going to be U-shaped. Okay, so when I take that total variable cost curve and divide it by Q, it's going to be like that. Now, a quick note, why does it look like this? Okay, and once again, I'm going to go back to using GM. Think about General Motors. Is there any, I mean, we all know that they have plants, and I'm going to say all over the country. It's predominantly all over the Midwest, but let's say all over the country. Okay, and each plant produces probably 1, maybe 2 vehicles. Okay, why do they do this? Why don't they just have one huge plant where they produce everything? Because if they did, they'd be way up here. Okay, GM probably has a couple 100,000 employees. Can you imagine trying to get a couple 100,000 employees into the factory every day? That wouldn't be very efficient. So what do? They have plants that are efficient and produce only 1 type of vehicle or maybe 2 types of vehicles. Why? Because then they can be in here. And why don't you want to be way down? Why don't you want those really low production vehicles? Because it's not very efficient. You're much better off if you can operate someplace out there, which notice is going to probably bring us someplace in there for our average variable cost. And so finally moving on to total cost, and I will come back to why the curves are U-shaped. Going on to total cost, we can talk in terms of our average total cost. And our average total cost is the sum of the average fixed cost plus the average variable cost. If you look at some of the tables in the book, they'll do it that way. Or you can take the total cost and divide it by the quantity. The average total cost curve is also U-shaped. Why? Because at low levels of output, the average fixed cost dominates. When output is very low, remember that average fixed cost curve drops like a rock? It was 75 grand for 1 unit and 37.5 for 2. It just falls, it plummets like a rock. But keep in mind, as we produce more and more and more, average fixed cost goes away. Average fixed cost at $75,000 when we produce 75,000 units is $1. So as average variable cost continues to rise, average fixed cost becomes minimal, and the average variable cost forces the average total cost upward. So at the early part, at low output, average fixed cost is king. At high output, average variable cost is king. And so because of this, it's U-shaped, okay? Because of this, it's going to be U-shaped. So if I take a look at my total fixed cost and my average fixed cost, then I'm going to add my total variable cost, but notice what's going to happen to my total cost. What my total cost curve is going to do is move perfectly parallel to my total variable cost, it's going to move straight up. Why? Because at this level, I'm adding 75,000 in fixed cost and I'm up there. Okay, so that's what's going on there as I move from one to the next, from one to the other. Okay, so my total cost curve is going to look something like that. Now my average variable cost is going to be U-shaped and kind of like that. And keep in mind, my total cost curve is the sum of the two. So here, I'm going to add this average fixed cost and this average variable cost and get this average total cost up here. But notice what happens. It plummets, reaches a minimum, and then gets up. And it's going to get really, really close to that average variable. As that average fixed cost approaches zero, keep in mind, the average fixed cost will never get to zero, but it'll approach it. As it does, that average total cost and that average variable cost out here start to get really close to one another. Okay, start to get really close to one another. Questions so far? Now, production at the minimum of our average total cost curve, is it our goal? And the answer is no. Okay, we do not want to necessarily produce at the minimum of our average total cost curve. I can't tell you the number of times I'd walk into a business and go, guys, you could do this so much more cheaply. And the answer might be yes, we could, but our goal is not to minimize average total cost. Our goal is to maximize profits. We want to make the most amount of money. And if that means we're at the minimum of our average total cost curve, great. But if it doesn't, so be it, because we're more interested in making money than we are producing at the minimum of the average total cost curve. And the key to this is the marginal cost curve. Okay, marginal cost is king. I said this, I think, week 2. If you get nothing out of this class, realize that it's always the marginal that matters. Okay, it's not the average, it's the marginal. What's going to happen with the next dollar? Okay, so the marginal cost is, what does it cost to produce one more unit? And so the marginal cost is the cost to produce one more unit. And the way I like to think about this is going back to my, McDonald's, Burger King, what have you, fast food place. What is the cost to produce one more burger? It happens to just be the cost of the burger, folks, because I've already paid the rent. I've already paid to turn on the power. I've got the gas onto the grills, and it's not going to cost me any more because I don't turn it off every time we don't have an order for a minute. Okay, so the gas doesn't cost me anymore. I've got the employees there. Okay, the only cost to produce one more burger is the cost of the hamburger, the bun, the lettuce, tomato, whatever else they're putting on it. That is the only cost to produce one more burger. Okay, another way to think about it, what's the cost for one more student in my class? Okay, and keep in mind, this leads to some absurd type things. The cost of one more student in my class is 0. I get paid the same amount whether I have 15 or whether I have 30 in class. Okay, now, so to go from 15 to 16 students doesn't cost any more. We've already paid for the Zoom license. We've already paid for, they've already paid me. There's really no additional cost. They've already paid student services to enroll you in class. They've already paid for, the finance folks to collect the tuition money or financial aid or whatever they're doing. The cost of one more is virtually 0. But at some point, okay, to go from 15 to 16, the cost is 0. But to go, and usually we use a class of 30 as a full class, to go from 30 to 31, all of a sudden changes the math. okay? Because now all of a sudden, we need another professor. We need another section. We need another class. So the marginal cost is the cost to produce one more unit. And the way to figure out marginal cost is we take the change in the total cost divided by the change in quantity. Okay, what's the change in the total cost divided by the change in quantity? Sometimes it's not as it's not easy necessarily to figure out the cost to produce just one more. Maybe you have to produce 100 more. So then you have to take the change in the total cost to produce 100 divided by the change in quantity, which is 100. So there's two ways to kind of look at marginal cost, and it's really, you know, the same, only from a different perspective. The marginal cost is the cost to produce the last unit. The other way to look at it is it's the cost that can be saved by not producing the last unit. How much am I going to save if I don't produce it? Think about it from, you know, McDonald's standpoint once again. If they don't produce that last burger, how much do they save? Well, I'm making 10 bucks an hour. I still want to get paid. They still got to pay the rent. The gas is on, so they still have to pay the gas. Okay, so the only thing that can be saved by not producing that last burger is the cost of the last burger, lettuce, tomato, whatever they're putting on it. Now, the marginal cost curve will cut the average total cost curve and the average variable cost curve at their minimum point. And the reason this occurs is because the average total cost and the average variable cost are related. And they're both going to follow the marginal cost. So if I am going to draw in the marginal cost curve, the marginal cost curve is going to look like that. It is going to cut the average variable cost curve at its minimum. It's going to cut the average total cost curve right there at its minimum. Because the only way to get your average to go up, folks, and I just explained this from a grade standpoint, but it applies in business as well. The only way to get the average to go up is to have the marginal above it. And notice, when the marginal is below it, what's it doing? It's driving the cost down. The marginal here is below the average total cost curve. What's it doing? It's driving that cost curve down. And you all know this from, 20 years of schooling. The only way to get your average to go up is to score better on the next exam, homework, whatever. The only way to get your average to go down is to score worse. Now, the marginal product and the average product are related to the marginal and the average variable costs. If you go back to where we started today, we had, when I had the pairs of jeans or the McDonald's, what have you, we had the average product reached a peak and fell, and the marginal product went up and down as well. And remember, I said it cut it at its maximum right there. And notice, and this is probably a better graph than I had up earlier, the only way to get the average product to go up is to have the marginal above it. And you can see it here. I mean, it's really apparent. Hey, what's happening is the marginal is above the average when it's going up. And then as soon as the marginal cuts it, what's it starting to do? It's starting to drag that average down. And if you look, the marginal cost and the average cost are kind of what I'd call a mirror image. If you took the top curve and just flipped it, if you took this, if you printed this on a sheet of paper and you folded the sheet of paper in half and just folded it down, they'd look exactly the same. Okay, so what's going on is as the marginal product goes up, it's driving the average product up. And as the marginal product is going up, the marginal cost is going down. I think I've got some numbers on the next slide that'll show this. And notice where the marginal product is at its peak, the marginal cost is at its minimum. Notice what happens. And this is the math that goes with those graphs. If I'm paying somebody 10 bucks an hour and their marginal product is 15, the marginal cost to produce it is 66 cents. How'd I get that? 10 bucks divided by 15. As their marginal product goes up to perhaps 19 units, the marginal cost goes down. So as the marginal product is going up, the the marginal cost is going down. As the marginal product is going up, the marginal cost is going down. But then notice what happens is the marginal product, it hit its peak and is now starting to go down. Notice what happens to my marginal cost. It starts to go up. So where the marginal product is at its peak, the marginal cost is at its minimum. Any questions? In the long run, okay, now quick note, everything I've covered up till now has been short run. How do I know that? Because we had fixed costs. In the long run, the industry can make all desired resource changes, so there are no fixed costs. All costs are variable in the long run. Okay, in the short run, you have rent, and you got to pay the rent every month, $3 grand, whatever that number is. In the long run, you can move to a bigger location and pay more in rent because you're doing so well. Maybe you can shrink, or you can go out of business. So in the long run, all costs are variable. So what we're going to have is the long run average total cost curve, which shows the least per unit cost at which output can be produced after the firm has had necessary time to make all adjustments. It is what we call the envelope that includes all the short run average total cost curves. So we're going to have a bunch of short run average total cost curves. Okay. And the long run average total cost curve, which is the white curve, is going to be the envelope which includes them all. And notice what's going to go on here. Is you're a small business and you have, relatively speaking, low output, your costs are up there. Okay. And as you get bigger and want to produce more, yes, you could produce on that curve out there, but it makes sense to get bigger and have a bigger plant. So what do? You move your location to a bigger plant. And now all of a sudden your costs to produce that output are down here. Once again, as you get bigger and bigger and bigger, the costs start to go up. It pays to get the bigger plant. So that's what's going on there with the long run average total cost curve. It's the envelope that includes all those short run curves. So now we can talk in terms of economies of scale. And economies of scale are where unit costs fall as firms' output rises. The question that we started class with was, why not produce everything? Okay, or why not be super big and produce it all? And the question is, it depends upon what your cost curves look like. Pepsi and Coke have very different cost curves than wineries. Because of that, there are hundreds of wineries, and I would argue 2 soda companies. Where we have economies of scale, unit costs fall as a firm's output rises. And so it's cheaper to have a large plant. The reason why this occurs is specialization. Okay, and that specialization takes the form of labor. Okay, managerial becomes easier to manage, and how we use capital. So it pays to get bigger. So so economies of scale is it pays to get bigger. Let me go back. So we have economies of scale all in here. It pays there to get bigger, because notice what happens as your company gets bigger, as you can build a bigger plant, your costs continue to go down. That's exactly what you want. So what does it do there? It pays to get big. That is economies of scale. Diseconomies of scale are where larger production leads to increased costs. Why? Because you run into managerial problems and efficient control. Why doesn't GM have one plant to produce all their vehicles in one spot? Because can you imagine the managerial issues of getting 200,000 or 300,000 people into work every day? Okay, it also becomes very difficult to control. So what we have returns to scale out here, increasing returns to scale. We have decreasing returns to scale out here. And we have what we call constant returns to scale here in the middle. Okay, out here, it pays to get bigger. Because as you get bigger, your total costs will fall. Out here, it pays not to be there. Why? Because as you get bigger and bigger, your costs go up. And then all of a sudden, we can see a whole bunch of firms. Let me get rid of. Now, all of a sudden, we can have a firm here, and a firm here, and a firm here. So we can have a big firm. We can have a small firm. We can have a middle-sized firm. And they're all competing, and they're all operating at their long-run average total cost curve minimum. Okay, and nobody in this industry is going to be out here because they're going to be inefficient. Nobody in this industry is going to be out here because they're going to be really big, but they're not going to be cost effective. And so now all of a sudden, you can see a bunch of companies operating in here. Okay, and it depends upon the industry, you know, how long this constant returns to scale is, but I'm going to use wineries. Okay, there are a couple of big wineries, okay, out in California, whatever. There are some big boys way out here. There are also some very tiny wineries in Virginia, New York, Ohio. I've been to some in South Carolina, what have you, that are really quite small. And how can they all compete against those big guys? Because relatively speaking, once you get to a certain point, you have what we call constant returns to scale. And so all of a sudden, a lot of different firms of a lot of different sizes can operate there to compete with one another. Questions? I don't want to do that. Let's go here. Just want to show you. Okay. Let's hope I can find it quick. See if it's here. Huh. Just wanted to show you, I mentioned it while I was talking in class that there's a bunch of different examples. And notice what's going on. Let's see if I can write on this. Should be. Maybe not. Maybe if I do this. Now let's see. Come on. Well, I can't. Let's just take a look at, notice what's going on here. Total fixed costs are $100 per unit. But notice when I take average fixed cost, which is column 5, I have 100 divided by 1, which is 100, 100 divided by 2, which is 50. Notice what happens to column 5, average fixed cost. It continues to go down. And if we had more output there, it would continue to fall even further. Okay, notice total variable cost. It goes up and it doesn't reach a maximum. So it keeps continuing to go up. Notice here it's going up 90 and then 80. Okay, and then 70 and then 60. So it's going up at different rates. It's going up slower and slower and slower. Okay, and in this case, even up here, well, once you get up here to like between 8 and 9, it's going up by 130. So it's going up slower, and as you increase output, it's going up slower, and then it's going up faster. Notice column 6 to figure out average variable cost. We take the total variable cost divided by quantity. So 90 divided by 1 is 90. 170 divided by 2 is 85. 240 divided by 3 is 80. So notice what happens. It goes down, reaches a minimum here at 74, reaches a minimum at 74, and then proceeds to go back up. So it goes, it's U-shaped, goes down, reaches a minimum, and then goes up. My total cost is the sum of total fixed plus total variable. So it's 100 plus 0 is 100. 100 plus 90 is 190. Okay. So my average total cost is 190 divided by 1. It's 270 divided by 2, which is 135. Notice what happens. It also goes down, reaches a minimum, and then starts to go up. And then notice my marginal cost. Now a quick note, how'd they get marginal cost in 90? Goes from 100 to 190, what's the change? 90. Goes from 190 to 270, what's the change? 80. Goes from 270 to 340, what's the change? 70. So notice what happens. The marginal cost goes down. It reaches a minimum. There's where my minimum is. Whoop. So there's where my minimum is, and then it starts to go back up. So that's how they calculated those numbers when you saw them in the text. Any questions? If not, I know I can write on this. I should be able to. There we go. Oh, this, I don't need that. Ignore that. I gotta go here. Oop. Next week, okay, we're going to do the assignment. And I've already set it up for the chapter on costs. And we're going to do the Learn Smart. And it's for 2 chapters, and I've already set it up on perfect, some books call it pure competition. Okay, so there's 2 chapters on it. One deals with the long term. The first one deals with the short run. The second one deals with the long run. Okay, and so we'll do those 2 chapters. There is no discussion board for next week. There will be one after the week after that, but there is no discussion board for next week. So those are the only 3 chapters. I may have a game next week. I'm going to work on one other thing to see what I have going on. Not sure. but may have a game to play. If I do that, I will not be recording while we're playing the game. I will record while we're doing the lecture part, but I will not record while we're playing the game. Questions?